We are live now and we'll begin our session. A very warm welcome to all our viewers to this edition of Cedrus Knowledge Series. Cedrus Knowledge Series is an initiative wherein we have one expert each month speaking on a variety of topics ranging right from investing to well-being. Cedrus Wealth Partners was founded in 2007 with the sole aim of providing holistic financial solutions to individuals and families. We at Cedrus Wealth believe in knowledge first, and the Cedrus Knowledge Series is one such step in allowing investors to make informed decisions amongst the various asset classes. For our ninth edition, we are extremely honored to have Mr. Ajit Menon as our esteemed guest. Ajit Menon is the Chief Executive Officer of PGIM India Asset Management Private Limited. As CEO, he oversees all aspects of the asset management business, including mutual fund and portfolio management services. He is responsible for the direction of the business and its growth strategy. An industry veteran, he has over 2 decades of leadership experience in business strategy, distribution, sales, and marketing. He joined PGIM India from Tata Asset Management Company, where he was the head of strategy. Prior to the Tata AMC, he spent over 15 years with DSP BlackRock, where he played a key role in the growth of the business. He is associated with the key industry bodies and is a sought-after speaker at various domestic forums and conferences. He has authored papers on matters pertaining to the AMC business, co-designed a 6-month certification course in wealth management and a 2-month retirement readiness certification course for business partners. He is also known for launching most number of international funds in the market. We look forward to having an insightful session with Mr. Menon. Once again, a very warm welcome to all our viewers and our speaker.
Thank you.
I
Thank
would
you,
now
Nati.
like to Thank you, sir. I would now like to hand over to Harmit to take the session ahead.
So thank you for the lovely introduction, Unnati. It is indeed an honor to have Mr. Menon with us for this particular session. A very good evening to all our viewers. The way this session is structured is that we will be asking Mr. Menon our set of questions. And if our viewers have any questions during this time, they can put the same in the comments box and they will be addressed at the end of the session. Sir, so my first question to you is that international investments as a category have recently seen a lot of interest from both investors and the mutual fund investing community. What is your take on this particular interest, and what would you tell investors during this time?
I mean, thank you very much, first of all, to Cedrus and all of you for inviting me for today's session. I hope that we have an interesting one for all of our viewers. As Unnati mentioned in a very kind introduction, that it's been over 2 decades of experience, and within that, I've probably I realize, the largest experience of launching international funds because of my stint at DSP BlackRock, where we did launch quite a few international themes. And I think all of those insights, meeting customers, meeting advisors, have put me in a unique position as I think about the international products and solutions that are available for investors here in India. So, to your question, in terms of the advice to our viewers, all investors at large, when it comes to international investing, I'd probably say take a step back. Take a step back and evaluate whether you're a saver, an investor, or a speculator. The reason I say this is because many a time I do find that people obviously react to high performance. And if you were sitting in December 2020 or early part of this year and you looked at these international funds, most of them were giving something like 60-70% kind of returns. And I think a lot of the reaction was because of high returns, not just for international funds, but also for domestic products per se. So the reason I say that you need to take a step back and think about yourself, whether you're a saver, an investor, or a speculator, is because the mentality and the attitude required to be any one of these three is very different. When you're thinking of yourself as a saver. You're looking at protecting your capital, making sure that your money does not, ever lose you don't lose your principal. When you're looking at investments, you're obviously, as an investor, you're looking at long-term wealth creation. But a lot of people mix up being an investor and a speculator, because the tendency of a speculator is there's great returns to be made now. Let's jump in, make it, and we'll be able to get out. And I would put probably things like the recent theme of getting into Bitcoins and things like that as part of that. Wherever there's high returns, let's chase it. There is nothing wrong in investing in Bitcoins or any other such category, according to me. But I think it's about recognizing that if you are an investor, you are basically investing in international products because of its long-term structural reasons to be part of your portfolio. Now, let me slightly expand on that. According to me, I think from an investor's perspective, you need to think about the options to invest as 7 asset classes, 7 different asset classes. So you look at equity as one, fixed income as the other, gold and precious metals, commodities, currency, real estate, and alternates. And when I say alternates, I mean things like private equity, hedge funds, investing in paintings and wine and Bitcoin, and all of those things are what I would put into alternates. Each of these asset classes has a different way of behaving to inflation and interest rates. And I think a good investor should try and keep money in all of this. Now, in international investing, you actually get the benefits of 2 sides of these asset classes: equity itself and also currency. And therefore, it makes an important option for investors to sort of consider. But let me give you a more simplistic reason as to why investors should look at investing internationally through the mutual fund route, through the FOF route, and there are other routes as well, which we can discuss. India is probably close to a $3.1 trillion in terms of its market capitalization, and GDP. Now, when you think about the global market, it's about $116 trillion market capitalization. So, most investors in India, 99.99% of their investments, according to even the Reserve Bank of India, is in the Indian domestic markets. Why should Indian investors not invest in the entire $116 trillion? There are so many sectors, so many stocks, so many themes which are not available in the Indian stock markets that are available globally, that becomes the most important reason why somebody should diversify into investing into international as well. So that's one simple way of looking at it. The related or the connected point here is what I mentioned, which is that there are many, many themes and sectors and stocks which are not available for investment in the Indian stock market. So when we think about an Amazon, or when we think about a Tesla, or when we think about, payment systems like Visa and MasterCard, when we think about luxury like, Ferrari and, Louis Vuitton, and you think about Apple, there are so many such very, very large stocks and sectors that are growing across the world, which are not available in India. And if you're an equity investor, you're basically looking to invest in good businesses. And so you should be therefore looking at also investing internationally, because these themes and sectors and stocks are available. And it's very easy for Indian investors today to invest through the mutual fund or the fund-of-fund route, where there is no limit to your investment and you can invest in rupees. So the convenience is available, the rationale is very strong, and I think that it allows you that amount of diversification because of the fact that you're investing into many ideas which are not available in India. I would put those as the big reasons why people should be considering this.
Right. Sir, the next question that I have for you is, you have already mentioned that there are a couple of ways that you can invest in these funds, a mutual fund route or the FOF route. So what I was coming to in the next question was that there is a lot of interest, but a lot of investors have very limited knowledge about these things. So for what would your advice be to someone who has a very limited knowledge about international equity funds in general, and how can they go about their investments?
Well, Harmeet, I do think that knowledge is a little overrated. as far as investing is concerned, whether it is domestic or whether it is international. And let me tell you why. Uh, you may have, and I don't know how many of our viewers or investors would have heard the name Harry Markowitz. Okay, Harry Markowitz was a Nobel Prize winner in the 50s, and his efficient frontier theory and many of the theories on portfolios is what much of the modern world, when it comes to wealth management, whether it is private banks, family offices, different technologies that are used for portfolio optimization, all of those are pretty much based on this Nobel Prize winning economist's theories. Now, when
Right.
somebody asked Harry Markowitz about his own investments, he simply said that, I imagine, what if all my money is in the equity market and the market goes down? That would be very painful. And what if none of my money was in the equity market and the equity market went up? I would feel very disappointed. So my own portfolio is 50-50, right? And this, you're talking about the person who actually gave birth to the theory of portfolio optimization, right?
Yes. Yes.
Even if there are famous stories, if you look up on the web also, for instance, of Isaac Newton, a man you would consider to be the most intelligent, one of the most intelligent men on earth. Now, he lost much of his wealth in the stock market, and he ended up saying that, I can calculate the movement of heavenly bodies very, very clearly, but I cannot calculate the madness of men when it comes to markets.
Right.
So what I'm trying to say is that the most intelligent people don't necessarily get it right, or necessarily know how to make returns, from the equity market. And I would therefore say that what is required for investors is simple common sense more than anything else. Now, you did mention that many investors, don't have much knowledge about the international markets and about international investing, but there is a lot of interest in investing. I would tell all of them that I'm sure that during this pandemic, most of you were watching Netflix or Amazon, and most of you probably have an Apple phone that you use, or Microsoft on your PCs, or that you have heard of Louis Vuitton and Teslas and Ferraris. And the fact is that these are the brands that are growing, making money all across the world. How difficult is it for us to therefore imagine that the reason that you invest domestically is because you feel confident about many of the sectors and stocks in India, and so you're just extending that to a global market which is now open to everybody. It's the entire thing is in the palm of your hand. There is so much of information that you can simply Google it up on your mobile phone. And just to imagine, Harmeet, that today the mobile phone that you hold in your hand, the entire technology that goes into that mobile phone is probably 100 times more than the technology that put man on the moon.
Right.
Okay, so it's that powerful. Now, so I would think that the real problem for investors is over information. It's a glut of information. There's too much of information that confuses you as to what to do. And I think, my own personal way of dealing with that, or when I discuss this with advisors or investors, I've always recommended to stick to a broad, diversified products, broad, diversified solutions, rather than trying to time things or try and get too narrow in your themes. It's
Right.
very interesting to think about artificial intelligence or robotics or healthcare or health technology, all of these sort of standalone ideas. But let me tell you that most of these ideas are also getting captured in diversified global funds. And so it is better to not take that kind of volatility if you're conservative, and go into diversified global equity funds when you invest, because there is a professional fund manager at the back of it who's deciding where to invest and how much to invest. Of course, I would probably tell our viewers that if you're a sophisticated investor, if you're a high net worth investor where your surpluses are upwards of $1 million, or much more than that, you can, of course, look towards some exposure to some of these upcoming themes which are there, which includes the Bitcoin, which includes maybe funds or ETFs which are primarily artificial intelligence or robotics or health technology related kind of funds. There are many interesting themes that people are interested in. ESG is another theme that you might be interested in. And
Right.
in India today, you have the option of LRS, which is the liberalized remittance scheme, which allows you to invest about $250,000 per person per annum. And you could utilize that avenue to pick and choose different products and solutions that you may have globally. But for a vast majority of investors, my advice would be stick to international fund of funds available in India, because you're pretty much getting a very broad exposure to all kinds of themes and sectors and stocks within those diversified funds.
Yes, sir. Building upon this question, we have a lot of geography specific funds. So you have US funds, you have China funds, you may even have Europe funds, and you have a pure international equity fund, as you mentioned, that is neutral to most geographies. Which, according to you, is a better option for an investor?
Again, I would say that for a vast majority of investors, pure international funds make more sense. If you're a very sophisticated investor, you have large surpluses, you can you can overweight or underweight, sectors or geographies or themes. Now, when you think about it today, United States of America is probably about 24% of the global GDP, probably a little above 40% of the market capitalization in the world. The next couple of them, China would be about 16% of the world GDP. And you have then Japan, Germany. India, like I mentioned, is about 3% of the world, 3.1% of the world GDP. So rather than take a China fund or a US fund, it is better to get a global equity fund that has these geographic allocations, and the fund managers decide where to overweight and underweight. Many international funds will already have high exposure to the US, for instance. It would be about 40 or 50 or 55% exposure to the US, because many of the global leaders in various sectors are based out of the US. And people would have exposure to, therefore, China or Europe or other emerging markets. So it's always best for investors, and I would say new investors and investors who are getting into this particular theme of investing, to look for pure international funds, for pure global allocation funds or global diversified funds, rather than try to pick up a US fund or a China fund or a Europe fund and decide what should be the percentage allocation to those. It's not, you don't need to do that, is my opinion.
Yeah, right. Yes, sir. The next question that I would like again to build on from this thing is that you mentioned around a US contributing to the largest portion of the global GDP, China coming in later, and India coming somewhere in the middle. My question to you is basically, how do you decide between the geographies while structuring an investment product? Is it a dynamic process, or do you have a fixed allocation in mind?
Well, there's no fixed allocation in mind, Harmeet, and I would say that, as far as PGIM is concerned, we've got a global equity fund as well as a global emerging markets fund. Again, the emerging markets fund is a diversified emerging market fund, because we believe that that has a great future as well. Now, we leave it obviously to our fund managers at PGIM global offices to decide what those allocations should be. In the Global Equity Opportunities Fund, the exposure to the US has been as low as 35% and as high as 60%. And then it really depends on the fund managers as to what do they think that their allocations should go to, which geography and which sort of theme. So after the US, there will be exposure to actually Europe as a very large entity, maybe about 25%, or to Europe and the Middle East countries. The Chinese allocation has been reduced in recent times, given a lot of what we have seen happening in China with the government coming down and clamping down on many of the high flying tech companies in China. And therefore, people want to have a wait and watch approach towards China. And therefore, those allocations have been reduced and other emerging market allocations have grown. So I think it is best left to a good portfolio manager who has the experience of looking at the entire world and the different geographies and thinking about what's happening, where are the consumers, where are the scalable companies, and then investing. One point I'd like to make over here, Harmeet, is that a lot of people think about ETFs and indexes, and that's one way of looking at investments. Much of what we believe in PGIM is much more active management, because we believe that indexes are built with a lot of the old economy sectors and stocks as well, whereas where growth is happening is outside of that in innovation. So to just elaborate on this point, and I think this is an important point, is that when you're investing in equity, my personal belief is that equity is the only asset class that captures innovation in the world. You
Right.
see, human beings progress. We make progress by inventing new things, new processes, new solutions, new products, right? All of this comes to market, and companies who are first to market or have a great product or service are able to disrupt those which have been there for a long time, and they're able to make profits as well. So, innovation is what makes these companies tick and grow. Now, innovation is therefore captured best in the equity asset class. It's not captured in commodities or currency or as much in fixed income or real estate or anywhere else. So, primarily, if innovation is captured in equity, I do think that fund managers who are sitting in our global offices are in the best place to think about where is the innovation happening, what is the most leading edge technology that is working, whether it is health or finance or products, consumers, payment systems, all of those things, and then it's best for them to decide which geographies to then invest into.
So my next question to you would be, so these currencies, I mean, these funds have a lot of international exposure, and that
Mhm.
means they could also be prone to certain foreign exchange fluctuations.
Yes.
So, what would the impact of a currency price fluctuation, such as that of a US dollar, have on
Mhm.
the performance of these funds?
Well, I would say that so far the impact has only been positive for as far as Indian investors are concerned since 1991 and the reforms that India took over. I think that the rupee, on average, if you look at it over 3-year periods, have probably depreciated about 3.5%, roughly around 3.4 to 3.5%. The rupee would have depreciated. Now, when the rupee depreciates, for an Indian investor, you're getting more rupees for every dollar. So your returns actually increase if the rupee is depreciating, right? And that's been the trend of the Indian rupee. And while usually investment managers and us, we don't claim to be currency experts, we don't manage portfolios with a very heavy tilt towards what's happening in the currency. We manage it on the basis of where do we see the strong growth themes emerging, the consumers emerging, the technologies emerging, the products and solutions emerging. These kind of things like the currency impact or the tax impact should actually be secondary. Having
Right.
said that, specifically to your question, the Indian rupee has on average depreciated over many years. Like I said, on an average about 3.5%. That means that Indian investors have always benefited. Those who are investing in rupees are getting more rupees to the dollar. And suffice it to say that most experts think that the rupee is not going to strengthen in a hurry. It is going to continue to remain reasonably weak so that we can help our exports clearly. And therefore, even going forward, I would anticipate that even though this is a secondary issue for investors, it will probably be in favor of Indian investors if it depreciates. Of course, if the rupee appreciates, it goes against for the Indian investor because now you're getting lesser rupees to every dollar. But that's a bit of a bet, which way it would go. I would say that's not so important for you to think about. It's important for an investor to think about the diversification that you're getting.
Right. So the next question I have is, what would the ideal investor profile be? I mean, what kind of an investor should actually consider investing in these kind of funds or international investment? And what portion should it be in his portfolio? What percentage allocation should it have?
Well, like I said, if you're an investor, all profiles of investor, whether you're young, middle-aged, or old, can invest into international funds, because it's pretty much like investing in equity, except that you're investing in equity outside of India. And like I mentioned earlier, you're investing because you believe that there are many companies, many sectors, many themes which are not available in India. And these are high innovation, high growth companies, and you can benefit out of them. Plus the fact that the rupee is probably going to be in your favor, even though that's a secondary aspect that you should be considering. I would therefore say that all profiles of investors can invest. And also because, today you have the fund of fund route through mutual funds to invest. It makes it very, very convenient. There are probably about 36 odd international funds available in India, roughly about 18,000 crores as far as AUM is concerned. Though out of those 36 different funds, I'd probably say there are only about 4 or 5 funds which are globally diversified equity funds, which is the kind that I would, recommend to any investor, rather than going into any specific theme or country, for that matter. Now, when it comes to the proportion of what you should be investing into international schemes, I think that you will hear most people talking about, have a 10% exposure at least. I believe that, a 10% exposure is okay, but it's neither here nor there. I would probably recommend a little over 10% as an exposure to international equities. I'd probably say, give it about 15 odd percent, and if not 20%. Now, why should you go towards 20%? I would probably say that if you are having children that study abroad, or if you probably think your kids are going to be going abroad to study, where you're going to be paying fees in dollars, if you're an international traveler and as a family you travel abroad, I'm sure that during the pandemic times, everybody's stuck at home and waiting for things to open up. But I'm saying in general, if you have businesses abroad, if you travel abroad, I think it's always best to hedge the rupee. And one way of doing that is to invest in the dollar. And these international funds allow you to invest in the dollar, because every time you invest, the money is simply sent abroad to buy the dollar NAV of the same portfolio. And so you're getting an exposure to the currency. And if the rupee keeps depreciating, you're still making more rupees to the dollar. So you're sort of keeping in touch, or keeping track of the increase in the expenses. If one were to look over the last maybe 6 or 7 years at international education, even if it was, let's say, $50,000, 6 years ago, 7 years ago, and today it's $50,000 as well, and nothing has changed. But in terms of Indian rupees, it is probably 60% higher than it was 6 or 7 years ago. That's because the rupee is depreciated. Now, one way of taking advantage of the depreciation is to invest into dollar funds so that you can keep pace. And so then investing 5 and 10% does not make sense for those investors who have children studying abroad, or who may have children studying abroad, business interests abroad, or tend to probably travel in later years when things open up. So I would recommend to those investors a little higher than maybe 15 or 20%.
Right. So, are SIPs a good option to consider while investing in international funds?
SIP actually is a disciplined way of approaching investments. It is nothing more than that. So it is a good option to do in domestic funds. It is a good option to do in international funds as well. I would also say that if you think about risk and volatility, and if you think about the fact that there is a currency impact, and international equities also go up and down, and there could be different political and geographical risks or thematic risks, in portfolios, then it is always better to invest through an SIP route. I would probably say that if you had invested in a balanced fund over the last 5 years, through an SIP route, your returns would have been somewhere about 14.8% that you would have got over the 5 years. But if you had added 20% of that to international funds, and again adopted the SIP route, your returns would have been somewhere around 15.3 or 15.4% return. It would have been higher. So I would say that SIP is only a mode of investing. It's a disciplined way of investing, especially for salaried individuals. And I would always recommend SIP way of investing into any kind of funds, but also definitely international funds.
Right. And so my final question to you is, recently NSE came out with a regulation whereby they allowed investors to invest directly in US equities.
Mhm,
So how much is this decision expected to impact the inflows into international funds,
mhm.
especially the US based funds?
Well, I don't see that to be too much of an impact, Harmeet. I'm sure there will be flows through that also. This is a depository receipt kind of option that NSE and BSE would do through Gift City in Gujarat. And essentially, you will have to adopt the LRS route to invest through that, the Liberal Remittance Scheme route, which allows you $250,000 per annum per person. So it is something that high net worth investors, ultra high net worth investors may use. And please remember that this has its own, documentation and taxation and all of that you will have to keep in mind. I believe that if you are getting international exposure in your portfolio through international equity funds, that would be a good enough route. And the new routes that are opening up, like the one you mentioned, would probably be more appropriate to larger high net worth investors if they choose to pick up single stocks, and they want to build portfolios in those single stocks or themes. A Warren Buffett might have his highest exposure in just 4 or 5 companies, and therefore very rich individuals and investors may also wish to have a large exposure to a Tesla or an Apple or any of those, and that they can use this particular route to do. For the general retail investor, I do think that international fund of funds continue to be the best way of investing into international equities.
Right. This was it from our side. It was really an honor to talk to you, and this was very insightful. It covered a lot of topics that we generally get from our investors. Now, sir, I believe it's time for the audience Q&A, and Unnati will take over from here.
Sure.
Yes.
That was an extremely insightful session, sir. I'm sure our
Thank you, Nancy.
investors have got a very good perspective about investing in international funds, and your key takeaway that diversification is the key for looking forward in investments for the global markets has given all the investors a very good perspective about the global funds. There are a few questions which I would like to ask you from the audience. The
Sure.
first question is, how would regulatory crackdowns on technological companies, especially in China, impact the performance of the international funds?
It's a very good question, Unnati, and I think that it is an appropriate question as well, in the sense that any investing comes with its risks, right? And therefore, when you're thinking about regulatory breakup of technology companies in China, you've also been reading and hearing about regulators and the governments looking at the large technology companies in the US as well. Now, all of this is something where a global portfolio manager keeps a watch on and decides on, how to look at their investments, when to move out, when to get in. And so it is better, I would say, for a retail investor not to think about investing directly into stocks, but come through mutual funds where there is a professional fund manager who is sitting there to decide which companies and sectors and geographies to take exposure to or not. So, to the specific question, I do think that there are risks. Those risks have already played out in countries like China, and fund managers like ourselves have reduced exposure to China. Much of that exposure reduction happened in anticipation of more regulatory changes, and therefore it would have protected, a lot of what investors, would probably have seen as an impact. But these are the kind of risks that would be there even in India. regulatory changes, whether or taxation changes, whether it is to telecom, whether it is to various other areas, electric vehicles, auto, PLI schemes. There are so many things that governments do that impact markets. So finally, in conclusion, I would probably say that regulatory crackdowns on technology is a risk, but it is a risk which is equal to all other kinds of risks that hit markets in general. And a professional fund manager approaching those investments is a better route for retail investors to think about.
Right. Sir, my next question is, for an Indian investor, would investing in developed market funds be a better diversification mode than in emerging market funds?
Um, Again, a very good question, Unnati, but I would probably say that you've got to be balanced in terms of the exposure that you take. The person who's asking the question is absolutely right in saying that it is so much more better that if you are an emerging economy, then for diversification purposes, you might as well then invest only in developed markets. But I would say that the characteristics of different emerging economies are different. The availability of scalable companies in different geographies within emerging markets are different. So if you're an investor and you're looking for good ideas, those are available in multiple places, and not just in India. As far as an emerging market is concerned, it is available in other emerging markets as well. And one must also realize that at the end of the day, when professional fund managers look at emerging markets as a whole, they think about the fact that the future consumers are coming from these emerging markets. As incomes rise and as people's aspirations rise with it, the consumers are more and more in all across the emerging markets, not just India, right? Yes, the developed markets, on the other hand, have a disadvantage that people there are getting older and older by the day in comparison to emerging markets. So demand for goods and services in developing markets are probably getting a little stagnant from a consumer's standpoint. But good companies which are listed in the developed markets are taking advantage of these consumers all over the world, including all emerging markets. And so I would say that there is not much to gain by trying to be so nuanced that your emerging market investment is just India, and for diversification to international, you just take a developed market exposure. It is true that developed market companies make profits out of selling products all across the world, including emerging markets. But I would say that there are many, many opportunities and companies that are there across these markets. So you could take a diversified emerging market as well as part of your international exposure.
Right, sir. And my next question is, sir, what is your take on investing in the European markets? Is the investments a value buy in Europe markets?
Well, it's a personal favorite. I like Europe, quite a bit because I feel in the recent times, if you see the entire narrative around ESG, right, environmental and social and governance as the metric for investing, there's a lot of noise all over the world, but not too many governments are really doing what is necessary for companies to be made accountable as far as environment, social, and governance needs are concerned. Now, if you were to take a futuristic bet and say that, well, everybody will have to give environment and social reasons, governments, politicians, all of them will have to focus on this. And obviously, therefore, rules and regulations will be such that corporates will be forced to follow many of these rules and guidelines. I think personally, from everything that I'm seeing and hearing and reading, Europe is a little ahead of the curve compared to other markets in the world. And that makes it a bit of a favorite for me. And I would therefore say that such a large part of the world, even though it may not have met all of the promises that it had when it all started, that it would be a great balancing act for the dollar, I think that hasn't happened. But the future can be anything, and it is very difficult even for me or any other expert to speculate what can happen into the future. You sort of take instinctive calls of what you feel. I personally feel that the European governments, the European regulators are always been a little ahead of the curve, and therefore, companies there are likely to benefit as these regulations come into force all over the world. Having said that, there will always be pros and cons for every region. It is only for a sophisticated investor that maybe you want to tilt a little bit towards Europe or China or any of such geographies. A good diversified equity fund always captures most of these ideas anyway.
Right, sir. And my next question is, what geopolitical risk is associated with the current situation of Afghanistan on the global markets?
Difficult to call that, Unnati, at this point of time, because things are still evolving and one will only know years into the future as to what is the real implication of whatever is happening to Afghanistan. There are experts here who, and I'm not talking of PGIM experts, I'm not talking of PGIM fund managers. We do recognize that geopolitical risk is a big risk, and things like an India, a US-China trade war, for instance, has bigger impact, on investments and things like that than much of what we are seeing right now. Having said that, since these can redraw political, lines, geopolitical lines, and advantages and disadvantages, one will have to wait and see, what could be the impact of something like this. But I think looking at it from an investor's perspective, this is another reason why you should be more diversified in your investments rather than trying to pick and choose a particular idea and making a bet that one may be better than the other.
Right, sir. This was it from my side. On behalf of Cedrus Wealth Partners, I would like to thank Mr. Ajit Menon and PGIM Asset Management for making the time to grace this event, and to all our viewers for tuning in large numbers and making this event a huge success. We will return next month with a new topic and a new speaker. Until then, stay healthy, stay safe, and happy investing.
Thank you. Stay safe to all of you.
Thank you, sir.
Bye bye.